Hi everyone, so welcome to Investing for Value. So today I'm going to talk about two new IPOs and what's the best time to get to know a company than when it actually comes onto the market, and there's just a big flurry of information and the stock is doing extremely well because the stock came on the market at $29 and it's at $84.66. Looking at 88.50 before the market's even opened. And let's look at the IPO date. This was July the 2nd, and we're looking at July the 10th, and that's only a difference of like 8 days, and this company's already tripled. So imagine holding that for less than 2 weeks and tripling your money. You'd be extremely pleased. So that's kind of one of those situations that really gets people interested in these companies because those gains are incredible. And, Agora, if that's how you pronounce it, has been doing the same thing, $20 open, and it's at $52 right now. And when did it come on the market? Okay, end of June. In a sense of, in the space of around 2 weeks as well, you're looking at about 2.5 times your money, and that's incredible returns. If you can keep doing those for, find one every month, you would really do really well, especially compounding those effects. But of course, it's pretty difficult to get into these IPOs to begin with, and when you're in there, you don't even know if it's going to be a good one or not. So, don't feel too harsh on yourself if you miss out on these. I'll miss out on all these all the time, and I'm not too worried. And my biggest question is, are they still worth getting into? That's the biggest question. The price has already moved. I could always wait for a correction if it comes back down, or I could think about, is this the right price right now? So currently the valuation is $4.64 billion for this lemonade company. What's so interesting about this company? Well, it's kind of known as a big disruptor in the insurance industry. If we look at the website, it kind of gives you a really good overview. So, the home and renters insurance, and as they say, it's built for the 21st century. And this is what's really cool. So you can get insured in as quick as 90 seconds, and you can put a claim and get paid within 3 minutes. So your question must be, how is that even possible remotely in any sense? Well, because they utilize the power of AI, and AI in the future is really gonna, it's gonna gather all that important data, and it's going to be able to assess you as a risk, and then, it's going to allow them to kind of tailor the platform to match your risk, and then for them to get the maximum reward out of your risk profile. So if you're someone who's, not getting into danger, not really claiming all the time, the chances are they're going to give you a very good deal. And if you have quite a risky profile, over time they're going to know, and that's what the really scary part about data just being so freely available. Over time they're going to be able to assess you as, this profile of being risky or not risky. So that's kind of what makes this company so interesting. But of course, an AI system that kind of ensures you after 90 seconds may not be ensuring you with the right aspects, at least not in the current situation. And if they're paying you within after 3 minutes, the question is, have they really assessed the situation clearly enough? And is there potential for fraud to be paid out over time? So, of course there's really good reviews, and things have been going pretty well for them. And what's really cool is they're doing the monthly subscription price. You remember, when you last bought insurance and you basically paid a big lump sum. If you pay a monthly subscription price, over time it actually works out pretty good for the company, and it also helps you manage your cash flow. So that's kind of what kind of interests me as well, because this is a company that's kind of breaking a lot of trends, and it's kind of, it is causing a huge disruption It kind of reminds me of the whole Amazon Prime situation where they basically get you onto a subscription, and over time the company just benefits from you using the company more, and data helping them to sell you more products in the future. And I think there's the same thing where maybe in the future all your insurance will be with these guys. So yeah, it kind of does look interesting, and they've looked at their customers, and these are the companies where the customers have come from. Some of them have been from like Geico, which is owned by Warren Buffett's Berkshire Hathaway. So, even though, you've got these giant companies, this little company is managing to take some customers away from them. So, it looks pretty interesting. As they say here, a flat fee to run everything. We pay claims super fast. If there's money left over, we give it back to causes. So, in this day and age where it's all about getting things done in a simple way and also being beneficial to society, this kind of company really, ticks the box. And your next best question would be, what's the financials like? Because we look at this product, this company, and it sounds really good. So the biggest question is, are these guys gaining traction? Because if you create disruption, in a sense, innovation, you need to know that you're getting adoption as well. So recently they did release some financials in their prospectus, and yeah, like in 2018, their revenue was 21.2 million. And in 2019, it was 63.8 million. So about triple that of the prior year, which is what kind of really has everyone singing about this company, because its revenue is growing like clockwork. And then when we get to 2019, we've got this 3 months. So if we look at these two numbers, this was sort of full 12 months, and then we've got this last 3 month numbers leading up to March the 31st. And yeah, like 10.5 million for 2019. And then in 2020, it was 25.3 million. So about 2.5 times, which is still incredible. Though, it's not quite triple yet. It's not quite triple as it was the prior years. But 2.5 times growth, which is, phenomenal. We kind of have to look at these things, and we think if this company can continue to grow these revenues at this rate, it's going to look very, very impressive. Like if we do a very simple linear projection and we go, this year they could get up to 100 million, and maybe, and if they could go from 100 million to 200 million next year, then that would be very, very impressive. Hence why the valuation, because you're looking at a company that might do 100 million revenue, but is worth 4.64 billion, which is, 46 times their revenue. At least what I forecast this year anyway. Never mind that they've actually, if they've actually done it yet or anything like that. So that's kind of what's coming on with this company, and it kind of just reminds me a bit like, what was the company? Beyond Meats. Beyond Meats also came onto the market with a big splash. Valuation went sky high, came back down. But if you look at the share price of Beyond Meat these days, their share price is even higher than the IPO price. It's actually valued around an 8 billion valuation. Whereas when Beyond Meat came onto the market and it was worth 4-5 billion, people were outraged by this valuation, and now it's at 8 billion. So I think with these companies, as long as they perform year after year, they're going to really justify the valuation. Of course, at this price tag, if you're interested in this company, I would say just invest a little bit, and as it comes down in pricing, then maybe you can average down. If it never comes down in pricing, I guess you have a little bit and you can ride it out, or eventually just sell it for a decent profit. But yeah, I wouldn't get too caught up in companies where the valuation is way too, frothy to, make that justification that you're actually buying with a margin of safety. And then let's jump to the next company, which is Agora. They're doing like video um, platform, video slash voice platform. Well, they're not quite like Zoom, because Zoom is a direct product, whereas Agora is more like the system that powers everyone else. So these are its customers, an example, and they've got some pretty interesting stats. So they say they power on average 40 million minutes of human connection per month, which is pretty incredible, especially right now, as things really pick up around, among people just talking on video or voice. Yeah, I kind of see this company doing really well, because it's kind of got a really diverse approach, because it's powering these other companies, and basically the more these other companies get used, the better it's for them. Whereas Zoom, everyone had to use Zoom for Zoom to benefit, right? So yeah, it looks interesting in that perspective. Yeah, so like, as a good point of research, always go to the website, see what these guys do. Do not just focus solely on the share price and go, the share price is going up, so I'm just going to buy the stock regardless. No, no, no. Look at this website first. Get to know the product. Understand why this company might be successful in the future. So if we go video calling, you look at Zoom, and Zoom was incredibly successful because of that video calling, especially for companies doing conferences and group meetings and all that. And then we're also looking at this voice chat, and then they also do real-time messaging. So it's kind of got so many, things going on with this company, that they are, building towards how we'll communicate in the future, if not right now, with the whole situation of the world, trying to keep a distance apart, and in using more innovative technology. This company really does stand to benefit. And if we kind of look at how things go, this company does have their headquarters in China, and I think the US as well. So, there is the China side of things where you might be a little fearful. Just like what happened to Zoom, they had that China side of things. So, I guess, you want to do a bit of research and make sure this is a company that you want to be in. But yes, overall, it's definitely an interesting company. And as you can kind of see, someone highlighted on the IPO day, that the share price went from $20 to $46, which is a 130% increase. But don't get too caught up about the increases. But let's look at the revenue. Revenues is always an interesting point. So in 2018, revenue was 43 million. And in basically in 2019, it was 64 million. So that's basically around about a 50% jump. But if we look at the recent 3 months of this year, it was at 35 million compared to 13 million for the prior year, first 3 months of the prior year. So that's kind of telling you how much this company is growing this year, based on the demand for the technology. Whereas we got 2018 and 2019, usually companies grow smaller revenues much, much quicker. But here we're seeing them grow revenues afterwards in a quicker speed than the prior years, which is usually not, it's not the trend for these companies. So that's a really good sign that in this environment, these guys are going to do extremely well. So I kind of feel like you've got yourself a mini Zoom here, where this company will, have that chance that it could potentially continue to succeed in a very, very good way. Of course, if we do that straightforward, projection, and we go for the next 4 quarters, they do 35 million. These guys are more or less looking at 140 million, so 140 million, and they've got a 5 billion valuation. It kind of brings us back to Lemonade, that these companies are just being valued at such high, sales kind of like sales to price ratios that just seem outrageously high. But of course, you're investing in these companies because of this insane growth that these companies are getting. And of course, we have to just take we have to take into account that these companies are losing a lot of money, of course. But that's actually here they're actually making a profit, which is pretty interesting, right? Because you would expect this company to be losing money. But yeah, it was just a tax difference. So overall, still losing money, as you would expect with these growth companies. Yeah, and as we can see, research and development costs continue to increase as time goes on, because that's what these companies do, and you just hope that they've raised enough money to just continue to burn. But apart from that, I'd say like this company definitely interests me a bit more than Lemonade does. Like even though Lemonade is very, very disruptive, I do feel like Agora's got that advantage where it's succeeding in this current environment. Same thing with Lemonade though, where you've got this age group I would say it tends to be younger people who would be interested in this company, because they're looking for cheaper options for insurance. Also, yeah, I guess more manageable cash flows, whereas you probably have an older age group which probably won't understand this company because they're not used to the whole, AI situation. But I think over time, this company has a chance to just educate the customer base, and it's not about getting everyone at the start, it's just about making an impact, and then over time educating all the customers, and then building market share out from there. I like these companies in terms of their business model, quite the same. In terms of more innovative, disruptive, Lemonade kind of takes that pick. In terms of essential needs kind of situation, I feel like Agora's gonna have that utility effect where people are going to make more use of the technology as this year just goes. So yeah, I wouldn't say like there's that pressing to buy into these companies. Even though they're doing something pretty cool, I'd say you want to consider these companies in their own aspects, and yeah, I'd say if you're interested in them, buy a little bit, but I wouldn't get like too obsessed. I do kind of see Agora having this massive effect over the long term, where it can get into those tens of billions in valuations, because they've got that whole effect where they're just powering everyone. Kind of reminds me of Twilio. So if you don't know what Twilio is, they basically do the whole powering behind that, or behind messaging. Like if you I guess sign up to something and a company sends you a message, chances are Twilio's behind it. And Twilio is one of those companies that have done extremely well over time. So like you can see from around 2017 or start of 2018, this company was around if I say like $26, and now it's at 241. So I kind of see the same effects happening with Agora over time, where the usefulness for this company will continue to grow over time. So hence why the long-term effects of this is probably much more easier to kind of define and see where it will be in the future. Whereas Lemonade's kind of being a disruptive player, and we have to see what every other insurance player is going to do to try to catch up. But if you're interested in both companies, no harm in investing a little bit in both. I wouldn't get too I wouldn't dive in too heavily into these companies, especially not at these valuations. If a correction happens, because obviously everyone's on hundreds of percents of profits, you kind of don't want to get suckered in and holding when everything plummets, at least have a lot of room to average down if anything bad was to happen in this current market. Yeah, like certainly let me know what your opinion is. Always interested to hear that. Until then, good luck investing, everyone.